All right, thanks for staying with us here. This is the third one in a row. Again, it's my pleasure. Actually, it's the first time that I'll have Jim Bianco on Hedgeye TV, so it's a real pleasure to have you here, Jim. Thanks for making the time to do it.
Yeah, thank you for having me. Looking forward to it.
You have a lot of fans on both Wall Street and on Twitter, and I think you're one of the guys that can merge the gap, if you will, between the real world and the economy and what Wall Street would maybe like to see sometimes. So I certainly appreciate that. There's been a lot of comments back and forth on free market capitalism. A lot of people are kind of concerned that that's been lost here, but I know that you have a lot of different thoughts on that. And that's really the first topic that I want to start with was, the legality of what the Fed has done or purports to be doing, and just generally how you think about that.
It is legal what the Fed is doing. The 13.3 provisions that the Fed has that were revised in the Dodd-Frank bill give them the ability to do this. And here's an important caveat: provided that the Treasury Secretary approves of it. And that's been what I've been trying to hammer along, was that what effectively has happened is we've merged the Federal Reserve with the Department of Treasury. And that what's effectively happened is that the Fed is not buying corporate bonds or ETFs or commercial paper or now municipal securities as of last Thursday. It is the Treasury. It is the government that's buying it. The Fed is just providing the financing. And when I hear Fed officials say to me, well, we'll get out of this when the time is appropriate. No, you have to get the Treasury Secretary to approve of you getting out of it. And that means you need Donald Trump to say, I think you guys are done money printing. I think you guys are done ramping markets up higher. And I have a hard time believing, especially in an election year, that that's going to happen anytime soon. So getting into these programs is easy. Getting out is going to be the real tough part, I think. And that's to come, and the problems associated with that.
Yeah, and we'll get into, you have an explicit opinion on whether or not that this creates a new version of economic gravity or not. But the beginning of that, I mean, that isn't that essentially what at least phase one, as Trump would probably call it, of MMT looks like when you merge the Treasury fiscal spending with money printing?
I think that's exactly right. I've been actually calling this MMT version 1.0 is what we're doing. Look, all the stimulus is something along the lines of 4 or 5 years of tax receipts. And I think a lot of people have asked the question of, if the Fed and the Treasury believes that this works, that they can print 5 years worth of tax receipts and not have any consequence, then why do we have an IRS? Can't we just get rid of the IRS then at that point and just have them print all the money that they need? Of course not. I think that there's going to probably be somewhere down the line some kind of consequence to all of this money printing. What and how we can debate, but I'd have a hard time believing that we could print several $1 trillion. We're up to $8 trillion right now, and it will have only pleasure and no pain, because if it did, then we'll print another 8 trillion. And then we'll print another 8 trillion until we go to the point that it becomes too much.
Well, doesn't that just mean that and thanks for simplifying it, that, by the way, not many people can do that in 30 seconds or less. But again, isn't that just at the pleasure of the people deciding to pay their taxes?
Yeah, I think that there's a lot of that right now, although tax payment is not at the pleasure of people. As the great economist Walter Williams says, if you don't pay your taxes, they'll kill you. And he said, go ahead, try and barricade yourself in your house and not pay your taxes and see how long that works. Eventually, guys with guns will come through the front door looking for their taxes. So it isn't not quite at the pleasure of the people, but there will be an argument to be made at some point that if it's not, let's do away with taxes, it would be, why do we have to end the money printing? Why do we have to end the stimulus or the bailouts or whatever we're calling it this week if there is no consequence to it? Why is it only in a crisis we can print and borrow $8 trillion to try and get us over the hump, but not in a crisis? Why can't we keep doing it then too? That will be a debate and a discussion we'll have to have at that point.
Well, I mean, there are plenty of academics. Obviously, you and I. That's not where we live day to day. It's certainly not where I want to go. I think I'd be pretty bored. But I mean, people always say, "Hey, look, can you give me a white paper on why you use the base effects to predict or use your nowcast?" I'm like, "Here's the white paper. The back test is like one piece of white paper. Have at it. Go for it." But Stephanie Kelton, for example. I mean, what do you think about that? I mean, she obviously feels like she's got one step in the door on this, and maybe Trump or whoever beats Trump, or if Trump wins, both would quite like that.
Yeah, I think so. I think, to put the Kelton and the MMT argument, to a simple test, they believe that you can print money or borrow and, increase government spending, pay for college, pay for healthcare, pay for whatever you want to pay for without inflation until you hit the point of inflation. Their argument is we can borrow a lot more before we hit inflation. I think my argument would be, I don't think we're going to be borrowed nearly as much as you think we can before we get to the inflation point. The MMTers do have a point. They say when you get to inflation, then you've gone too far. And their remedy for that, by the way, is to raise taxes. And that's the way you remove money out of the system. Good luck with that. It's trying to turn over. They want to have tax rates be like the Fed funds rate, where it goes up and down with the level of inflation set by a bureaucrat like the Federal Reserve. I'm not so sure that society's quite ready for tax rates to kind of go along those lines. But to the larger point, I don't think we're going to find that printing and borrowing to the extent that we are is going to have a consequence a lot sooner than we think it's going to be. The MMTers think it's like 10, 20, 30 trillion dollars we could do before we hit that level. I don't think it's going to be nearly that much before we start seeing problems.
Well, what if the consequence is the one that we've already seen in 08? And again, it's not 08. I want to make sure that everybody knows that I don't think it's 08. I think it's 2020 and it's quite different. It could be worse. But again, what if the consequence is that people don't believe the bullshit and asset prices just go straight back down?
That is a big consequence, I think, right now, because it's a flip side of this story is we are going to take what the Fed is doing in supporting markets. Let me go back to my first argument. What the Treasury is doing through the Fed is nationalizing the markets.
Right.
They are basically taking them over. And by the way, and I'll give you the names too, Wall Street is cheering this as loud as they can. Bob Michael, this chief CIO fixed income of JP Morgan Investment Management, he thinks they haven't gone far enough. He wants them to set the price of every bond in the country. Rick Reeder at BlackRock has been cheering this program as well. Mike Wilson at Morgan Stanley, David Kostin at Goldman Sachs has abandoned his 2000 S&P call because money printing is good and what the Fed and the Treasury are doing is good. Well, we're going to put that to a test right now. And here's the simple question you have to ask yourself. Is the market near fair value? Is the market somewhere where it would naturally be? And I like to say, if a red headline came across my Bloomberg and it said, Jay Powell changed his mind, canceled all the programs, would the market go down a lot? Yeah, it would, because we've supported it at an artificial level. I think the Fed can do that for a while, support a market at an artificial level, but not forever. Eventually, the weight of where the market should be will come to bear on it, and it will fall, and it will fall down. So we're going to put this money printing thing to a test. The difference in 09 was they started it after the market was down 50% and 2 years later. So they got, if you will, lucky, or maybe they got smart. They started it when the market was somewhere near a fair value level anyway. This time around, they started it 2 weeks after the all-time high and then kept ramping it up all the way to last week and continued to ramp it up. And the question is, if the market's near where it would have been anyway, then this will appear to work. If the market should be severely lower, and that's what my fear is then it won't work over the long term. It'll work for a while.
It's an amazing thing. I mean, I was back and forth with Danielle DiMartino Booth on this. There's this, and you probably can empathize with this. I think I'm probably barking up the right tree. If I'm not, then too bad. But this whole discussion, you and I have discussions with the same types of people. Don't forget the JP Morgan gentleman that you named. He doesn't quite want to talk to me, and I'm not completely surprised why. JP Morgan's a client, to be clear. In terms of independent research, they pay for a lot of independent research. But again, the whole you didn't get it. You didn't know that you shouldn't fight the Fed. Like that discussion, I tell you, Jim, that drives me bananas. Like that drives me bananas. Like all you great fundamental investors who only talk to me about how good the cycle is and how it's different this time, as soon as it turns fundamentally, you turn tail to that and you tell me I'm the idiot? I have a hard time with that.
Well, let me jump in and say I agree, because what you're saying is, and let's not mince words here. What we're saying is all this analysis we do is bullshit.
Right.
Because it works in an up, it works in the up, but then in the down, you can forget everything you've learned about how finance works. Don't worry, the printing press will just bail you out. Well, why do we even need analysts? Why do we even need anything if that's the way the market's going to work? That it always is going to be supported by some artificial force on the way down. If you believe in free markets is, remember what free markets are supposed to be. Let's not forget what we were talking about here. We have a finite source of capital. We don't have all the money in the world. You'd think we did with the Fed. And we're trying to efficiently allocate it. We're trying to give it to good ideas and take it away from bad ideas. If we continue to go down this road, we're going to use an Austrian term, we're going to create malinvestment. We're going to just give everybody, Bob Michael from JP Morgan, he wants to fix the price of every corporate bond at 2%. He said that last week on Bloomberg TV. Okay, if you fix the price of every single corporate bond at 2%, there's no point in doing credit analysis. Everybody gets the same price, whether it's Carnival Cruise or it's Amazon, whether it's a disastrous business model or a great business model. Everybody's going to get funded, and you're going to create all kind of dislocations and problems in the economy because you're not being efficient with getting rid of bad ideas and rewarding good ideas.
Well, you're being completely conflicted and compromised for your own interests. I mean, that Bob Michael, I don't know who that is. Now I know, but his son, if he has a son named Billy Bob Michael, isn't going to work on Wall Street because, like you said, there's no job to do.
Right, exactly, and I think that this is what the idea is supposed to be. I mean, in theory, if you believe that the market was overreacting in March because what's happening with the virus is not nearly as bad as the market was saying, then bring it on. Give me great opportunities to make money. But if you're going to arrest it before we get to some kind of a settling out in the market, you're just going to create more problems in the long run, I think, at that point. But you know what? If you look at Wall Street and if you look at policymakers, no one's thinking about the long run. One of the things I've really been railing against is everybody talks about, well, what's the second quarter going to be like? And what's the third quarter going to be like? And when's the restart going to start? And I'll use some technical terms for you here. The second quarter is going to be a shit show. The third quarter is going to be less so of a shit show. That's all the analysis you need to know. What we really need to discuss is when this is over, the virus, and it will end, what's the long-term consequences of it? Are there going to be changes in social behavior? Are there going to be changes in the way we conduct business? Is there going to be some kind of deglobalization as well? And those 17 million Americans that have been unemployed in the last three weeks, that if you believe tomorrow's number is supposed to be another 5 million added to that roll, 22 million, how many millions of those people don't get their job back or have lost their businesses because of that? And what kind of anger and resentment does that bring up too? Boy, these are questions. Everybody looks at their shoes and says, boy, let's just not go there. Let's just talk about how bad the second quarter is going to be so we can talk about how much less bad the third quarter is going to be. And that seems to be the extent as far as they want to take it right now.
Well, and Wall Street just voted on that. I think, like, even if I look at my own client base, which is hedge funds, mutual funds, I think we have actually the same client base. So you probably had the same feedback. There's this like super short-term panic. Obviously, the pressure on people to perform on a very short-term basis at the hedge fund level in a quote-unquote neutral environment's never been higher. So people are just flat out running in fear of their own job. But yesterday, JP Morgan was quote-unquote up on the bad news. And I'm like, just chill out. I mean, let gravity play out. I don't think that people are going to actually believe Jamie Dimon's loan loss reserves here. I don't think that they're going to believe his outlook. And by the way, I do believe in economic gravity. So the credit cycle exists, gravity exists, and we're going to go through it. So I agree. You're going to have to go through the shit show and look at what the financials have done in the last 24 hours. I mean, they've led the market lower, and they're the first ones to report their version of reality, which I don't know if you agree or disagree, whether you call it a shit show or not. They have no idea.
Yeah, I know. Not only that they have no idea, but if you look at what they've done is they've just made a guess as to what their loan loss reserves are going to be.
Exactly.
And those guesses on those loan loss reserves are much larger than the analysts that cover these companies thought that they were going to be as well. So there is just a guess so far. Because for the moment, no one has really defaulted on a loan. If you stopped paying it 3 weeks ago, it's not in default yet. It will be soon, but it isn't there just yet. And so we have no idea, where this ultimately is going to go. And that's what we're trying to guess and stuff. But I ultimately think it really comes down to that long-term question that no one wants to touch, right? What happens on the backside? When this is over, do we want to have a more conservative attitude? Do we want to de-risk? Do we want to de-globalize away from China? Do we want to reward, to use a Muhammad El-Arian term, do we want to reward resiliency in a company's business plan over efficiency in a company's business plan? Right now, it's close everything and send it to China because it's cheaper. But now we might say on the other side, we might say, how is your company going to respond when we have to close again for 3 months? Are you going to be able to survive? And are we going to reward companies that set themselves up like that? Well, that means that we're going to have a slower growth, less aggressive attitude than we did have, say, in January of this year. Now, Wall Street wants to believe there's going to be none of that, that it's going to be right back to January 2020. As soon as we're done with the mass graves on Hart Island, it's right back to 2020 and everything's going to be okay. I tend to think that that's not going to be the case. There is going to be changes in how we do things. Now, I may be wrong on what the changes are, but what would shock me is if the answer is nothing changed by the end of the year, that we're just back to the way it used to be, less 25,000 dead people. Yeah, I say that sarcastically to kind of emphasize my point.
No, it's classic actually and predictable, proactively predictable indeed. That's how Wall Street thinks. They think on a linear basis. They think you go down to one side of the V on a linear basis, you can go right back to the other side of the V, and if Bob can mark all the prices at the top end of the V, you never have to worry about having any W's in between. So it's like that is a shit show. In my mind, I wonder what you think about this framework because on the fly I'm trying to go from depression to what's the recovery into some version of a recession to an actual recovery. There's the workout period, of unemployment, what that means, and the credit cycle, which is one and the same thing. You lose your job if the company loses their cash flows. Liquidity is not solvency, so again, that's one. Two is behaviorally, like to your point, I don't fucking know. Point number three is actually the one we started talking on our research call about a little bit more in the last couple of days, which is the regulatory environment. Like, what is the new America in terms of how you're allowed to operate, how you're allowed to have your liberties or civil liberties in your consumption versus the prior. This is a whole new world. So those three things to me, and that's starting with a lot. Have I left anything big out that I need to think about from a intermediate to longer term cycle perspective?
No, I think that's exactly right. Those are going to be the things. And you're right about the third one, which gets talked least of all, is going to be the regulatory environment. Look, what a lot of these states have done has been nothing more than turn their state into a police state. Now, I get it. There's a virus out there, and we need the social distance and hand wash. And what are we hearing from the White House right now? Hey, it's not going to be 100 to 200,000 dead or 2 million if we did nothing, but it might be far less than that because everybody understood. And I was like, you don't trust people. Why don't you just lay out the case? Here's a virus. This is what you need to do. Stand 6 feet apart, wash your hands, wear a mask. And McDonald's, you can stay open, but figure out how to work within that framework instead of just summarily closing everything. Right. And then deciding when we're going to open, or doing like the governor of Michigan has decided. Big box retailers have to close their garden department, but can keep their grocery department open. So if you go to Target and you buy groceries, it's okay. But if you go to Target and buy a garden hose, you're going to be arrested. They're coming down to that level of detail right now in terms of what they're doing with a lot of these companies. I don't think they're going to give that back so easily. And I do think that there's going to be some anger and resentment as they are very, very slow to give that back. And they'll use the argument of a reinfection wave. And when weeks come into months, which come into quarters of having these restrictions, it's going to weigh not only on the economy, but on society in general.
Well, that workout period, I mean, if you only use economic, never mind shallow recessions, which we had a very long workout period of corporate leverage come, as you guys can throw up the history of it all, guys, if you can, on slide 33. We're just showing Jim, which obviously, on the backside of your hand, what's happened economically across cycles. But, you can look at some of the most, actually slide 34, the shallowest recession, which was, again, a corporate credit bubble in 2001. The workout period was 9 months. The similarity was that you had an economic shock at precisely the wrong time in the cycle. I think a lot of people screw that up too. They're like, nobody could see this coming. That's total bullshit. Just like in 01, the economy was slowing in 2019, and then it just made the virus, and in that case, 9/11 made it slow faster. But again, the workout period was at least 9 months for the corporate credit cycle, in terms of the economy actually bottomed, as you know, in 01 before actually the stock market did. And that was back, that took until 02. So I don't even know where people are going when they think, if they only studied economic history. I know it's never the same, but even if you took the 44 months of the Depression and the 9 months of 01, it's not 2 months.
Oh, exactly. If you could put that slide back up, I'd also point out something else too. If you look at the 08, December 07, 09 period, peak to trough decline was 5%.
Right.
5%. We're expected in the second quarter to have a decline, and a total decline in the U.S. economy is 6% just in the second quarter. The second quarter alone will be worse than the entire Great Recession will be. And, I've heard people say this without understanding some of these numbers. They'll talk to me about China and they'll say, well, China's 80% of the way back to where it was, as if that's a bullish argument. You mean they're 20% off the top? You mean that the Great Recession was 5% off the top? That's 4 times worse. That's a depression is what you're at if you're 20% of the way to the top. Yeah. We have to get back to 98, 99% of what we were in January in order to say that there's really no impact. If we get back to 90% of where we were in January, it would be devastating for, I think, a lot of people. Keep in mind this, at the bottom of the Great Depression in 1934, we still had 75% of the economic activity we had at the top, and we had 78% of people still had their jobs. That means we were 25% off the top, we had 22% unemployment. So I think what you need to understand is it doesn't take much for this to upset the apple cart as well as where we're going to go. And people are not ready to go there. They're all mean reverting thinkers. They all have their model that's pre-virus, and they think that the virus is just a temporary interruption so we can go back to that model and we revert back to that mean. But what I'm worried is they're not really understanding that this is a new era and that we need a new model of where we're going to go. It doesn't have to be a disaster. But my fear is if we don't handle it right, we're going to make it a lot worse than it needs to be.
Yeah, amazing disconnects between what you just said and where our friend Bob wants to mark the price or the valuation, however you want to contend it should be there, of markets. And it's just that is the disconnect. And I guess to me, if that's what you're saying, is if there's a widening disconnect between where the officialdom wants the market to be priced, again, centrally planned and priced, versus where the actual economic gravity is, everything in between, last price, to where that washes out is the risk. I mean that.
Right.
So, have at it. I mean, I don't know how else to think about that, and the answer isn't buy stocks.
Right. I'll give you an example of what we're talking about with the disconnect. Something interesting has been happening in the bond market, which has not been appreciated. So on March 13th, the Fed ended this not QE argument by saying, okay, we're going to do QE, we're going to buy out to 30-year bond. And they ramped that up to 2 weeks ago. They were buying $600 billion a week in bonds. That since March 13th, they've bought over $1.5 trillion worth of bonds. Now, these numbers are hard to understand. That you bought $1.5 trillion worth of bonds. If you watch mutual fund flows, if you had like a $200 billion year, that would be a big deal. This is $1.5 trillion in a week. So now if you look at yields, you go, okay, but they haven't moved much in the last 2 weeks. And I've argued if this market was anywhere near normal with that kind of borrowing, the 10-year yield would have opened at 0 and it would have been on its way to negative. Why hasn't it moved? Because if you look at fund flows from ETFs, from mutual funds, from households, from central banks, you could measure 600 billion plus of selling that has been going on. And that's just from the finite set of measures we have. There's other metrics that we haven't seen. So when you add it up, what is happening is official time has been buying bonds at the rate of trillion plus a month. And everybody else has been saying, you're holding this at the wrong price. And if you're going to do that, I'm selling it to you. And they're selling it to, they're massively liquidating to the central banks in a big way. They're making a powerful statement that when all of this is done, I think interest rates are going to be a lot higher than they are right now. Either it's a combination of inflation is returning, or it's finally that supply is going to crowd out the market. I started in the bond market in 1987. And for 33 years, I've heard people say to me that we're going to have these massive budget deficits that are going to crowd out and drive up interest rates. And for 33 years, that wasn't the thing, because we were playing child's games between a 1 or 2 or 3% deficit, maybe 4 or 5 in the middle of a recession. Now we're talking 15 to 20 is what we're talking. Now you're going to finally start to see that crowding out. So the bond market is trying to tell you that the fair value is probably a far lower price or a much higher yield. And the only reason you're not seeing that is you're getting astronomical types of buying out of the Federal Reserve through their quantitative easing program that's holding it up. But eventually, like I said, they can't do that forever. And I think that will eventually give way to higher interest rates as we move forward from here.
Well, if you look at, and when you come on, and people like to talk about the other side could also be stagflation,
Right.
A recessionary stagflation. And to get that, in the way that my model works, my 4-quadrant model, is that the faster and deeper you go in what I call quad 4, both inflation and growth slowing at the same time. Quite clearly that's happening despite President Pump on oil. To the point that you get deep enough, you can only reflate from there. So it doesn't take much, for that switch to turn, for you to go from deflation to reflation. And, given the economic conditions, I mean, that to me, every single time I make a call on reflation, it's not like German style reflation or inflation. And I don't know, maybe, who knows? It could be anything to me. I care, but I do more what the market's doing. That's the point. I mean, isn't it amazing that, and I call him that, I think, just because it's got some good alliteration, and he's a good marketer. So, I mean, I think that you and I can do some good marketing too. President Pump did everything that he could. He made up quite literally the barrels per day on one day of tweets, because he saw that, he was having some impact in the equity market. And look where oil is today. I mean, oil, the Fed's not buying oil. The Fed's not buying Jamie Dimon stock, so they're free to fall, and at some point they're going to stop falling, I guess.
Right. Oil, what's happened with oil, by the way, I'll tweet this out for anybody who's watching after I get off this call with you, is the EIA, the Energy Information Association, put out their implied gasoline demand numbers, lowest ever.
Yeah.
Down 50% down 50% in 3 weeks. In other words, think of gasoline demand as a metric for economic demand, and it's halved. It's halved in 3 weeks.
Yeah.
Man, that means there is a world of hurt out there. But to the inflation argument, yes, for the next couple of quarters, the big story is going to be deflation as we deflate the economy. But if you're going to print and borrow trillions of dollars and hand 22 million people unemployed an extra $600 a week, and maybe paycheck protection loans, and try and support these markets, you're going to support demand as best you can. But supply, companies not working, going out of business, are going to produce less stuff, higher demand, less supply, higher prices, more inflation. That seems to be where we're going to go after we go down. Because I think what we're doing, when people ask me what letter we're going to have, I used to say we're going to have both a V and an L. We're going to have a V, which means we're going to have a big sharp contraction. We're going to recover some after the virus passes, but we're not going to go all the way back to the high. So that's your L. And if you're going to artificially support demand, even though you don't have that supply going on, that we're making things you're going to have higher prices at the end of the day. You're going to have some lower prices in the form of commodity prices. Gasoline and other things are going to be demanded less, but people are going to be out there going, well, I got some money here. I might as well go buy a PlayStation, or I might as well go buy an iPhone because the government's been giving me money, but they're not going to be making as many of them because the supply constraints are going to be on them as well, too. You're going to have all kinds of distortions in the economy.
Of course.
So, yeah, you can have both deflation and then inflation coming out of this both at the same time.
I mean, that's classic what the market, stocks and credit, which have had, basically 100 different W's in terms of expectations since the market crashed. The bond market's had that right. Deflation, that's when bond yields go down, obviously. It's where the Fed panics. It's what the commodities markets told you. It's what the foreign currency markets have told you. It's just this incessant debate about the stock market that can drive human beings mad. Okay, I'm going to start to, if you don't mind, I'm going to start to knock out some of these questions here in the queue because
Sure.
You have a lot of, like I said, a wide following, and there's some really good questions here. On the first one, why there seems to be no movement or revolution away from the Fed? I think that this is like, why? And basically the question is, why are Americans fine with this? I don't know if they are.
They're fine. They're fine with it because they think it's going to work. They're like Wall Street. At the end of the day, Wall Street can say, this is how the world works. This is what I believe. But all they want prices to go up. And if they think this is going to work, there's going to be no pushback on it right now. And their argument is going to be because it worked the last time they tried it, which was in 2008. And so I think the pushback comes at the failure of it to work, at the failure of it to come to pass. And I'll give you, if you want a statistic to look at, in fact, I was just writing this a few minutes ago. I think right now the most important economic statistic everybody watches is initial claims. How many people lost their jobs this week? Remember, that's initial. How many people filed this week for unemployment insurance? There's another statistic called continuing claims. How many people are staying on unemployment next week and the week after and the week after? That number is expected in the next 2 weeks to go above 20 million. Well, if these Paycheck Protection Plan loans and the Fed is going to work, that 20 million, 25 million of people on unemployment claims should start to fall fast. Not because the economy is recovering, but because the assistance programs are getting them back in their jobs, even though they're getting paid to do nothing. I have a fear it's not going to happen, that they're going to stay unemployed.
Yeah.
And that at the end of the day, all this talk about this program and that program, and the Fed did this and the Fed did that, I'm going to look at continuing claims. You're going to look at continuing claims and going to go, there's tens of millions of people that have lost their jobs.
Yeah.
And that is going to then feed that resentment that we'll see. Look, we could be wrong, and maybe that 20 million of continuing claims will quickly become 8 million or 7 million of continuing claims. Because remember, if a company takes out a paycheck protection, a PPP loan, they have to hire back everybody. And then they have to apply at the end of the summer to show that they still have everybody, they didn't lay off everybody, and then that loan is forgiven and they get to keep the money. So if we see that continuing claims dwindle away to very little numbers, then these programs worked. If we don't, they didn't work. And if they didn't work, then you're going to see the resentment. Right now, no one's mad because they think that these things may work. They're waiting to see whether or not they work or not. But if they don't, I then think you'll see that resentment.
Well, that's another way to talk about like the short-term panic by both the Fed and the fiscal, is that it's trying to get it all done now in the absence of having the time for it to actually play out. And the way that I've looked at that is that it finds its way into market volatility. So the market volatility shows you that markets I think their equity markets and parts of high yield are uninvestable. But again, until the volatility goes away. The volatility goes away when the economic circumstances become clearer. That generally is a function of cash flows coming back, people getting their jobs back. But on slide 78, guys, just so that people can see what Jim means, because I think I said this every meeting that I had for the last year, because the U.S. economy, as you know, peaked at the end of Q3 of 2018. Initial claims in a recession is weekly number, the number one causal factor to be watching in terms of the pace of the economy. This thing is way off the chart. Like, there's no, like, you and I, like bean counters, like, we can't analyze it. I can't believe that all these people are so certain in their grand central plans that you can knock out, essentially, don't forget that you're going to knock out, depending on what this number is on the right side there, the cumulative employment gains, you're going to knock out 90% of the cycle. That's a 129-month economic cycle. And then everybody's just going to magically come back? I mean, we're saying that at least 2/3 of the jobless claims are permanent. Right,
and I think that that's going to be the real fear, is that the officialdom is hoping that these plans are going to get everybody back to their job, and that you're going to get paid to do nothing, but you're going to be there for the restart, is what they're going to want you to do.
Right.
But if you're right, 2/3 of it is permanent, there's going to be a big backlash. That's going to be considered a gigantic failure on the part of officialdom. And if that happens, and at the same time, the markets are perceived to have not fallen apart, which is for the moment where the euphoria is on this 50% retracement of the decline, you're right back to the anger that you had in late 2009 with the Tea Party movement and Occupy Wall Street, that the rich and connected got bailed out through artificially supporting their asset prices at high levels, but everybody else didn't get bailed out as well too. So that's going to be a real problem. I think you're right that ultimately the thing that's going to matter the most is going to be that initial claims, which becomes continuing claims.
Yep.
How many of those people get their jobs back? Because if not enough of them get their jobs back, then this didn't work. This being these bailout plans and everything else to try and support the economy didn't work. And if the stock market decides to have, bubble fever again and make a run at 3,000 on the S&P, and you've got CNBC and Bloomberg and Fox Business telling you the markets are okay, but you lost your job, you lost your life savings in your restaurant, that's not going to sit well. Those two things are not going to, that's oil and water, trying to put those two things together at the same time.
Yeah, I think that's bat soup crazy. I mean, to think that that's all going to work on a linear basis.
Right.
Another question here, and this is an important one as well. Trump being as chameleon-like as he always is most likely, and already has moved towards the new narrative, like calling it the Wuhan crisis. One of our clients the other day called it the China 19. You could see how people go there on the blame game. But as U.S. companies reassess their reliance on China or wanting to do with them at all, is there a possibility of another China trade deal fallout before the election?
Oh, I think that there's very little chance of a China trade deal before the election at this point. I do think the thing about whether or not you think China was at fault or not, the fact of the matter is it started there and it came out of there. And so we know that. When you start hearing Rick Scott, senator from Florida, last week on TV, getting very emotional and angry and saying something along the lines of anybody that buys a product made in China is immoral. Now, 60 days ago, he would have been mocked and laughed at as a kook for saying that. Today, who's going to support China? Is Macron going to support China? He's got 17,000 dead people in his country. Is Italy going to support China? Is Boris Johnson going to support China? He nearly died himself from this as well. So anybody that's going to want to push on China and say they're at fault, remember it came out of there, and it's your fault and we need to punish you, there's going to be no natural constituency that's going to push back against it. Is Biden going to push back against it? Does he think that that's going to be a winning strategy to defend China after what everybody has gone through? So there is going to be the scapegoating from China. Now, maybe it's not scapegoating. Maybe it is appropriately assigning blame because of the way that they've mishandled it as well, too. And I think Trump opened the door for that yesterday with his I'm not going to fund WHO anymore, the World Health Organization. That is almost by definition saying that WHO got it wrong because China told them to get it wrong. And that's where we're going to go. So there's going to be a lot of anxiety, let's put it that way, with China. I don't know if I'd be shocked if we're going to be looking at more trade deals. Look, over the weekend, Larry Kudlow, who signed off his show for 10 years I believe free market capitalism is the best way to prosperity, said the government should pay the moving costs of American companies to relocate back to China. That's not very free market capitalist, but it might be something that will get a lot of play and a lot of understanding in the country as well too. So in that environment, no, there's going to be no trade deal. Trump, I think, is, he keeps saying the Chinese are going to buy all these soybeans from us and we'll see whether they do it. I think he's waiting for them to not do it, and then he's going to unleash on them as well too.
Well, they don't have the money to do it. The Kudlow thing just cracked me up, by the way. I mean, I remember going on Kudlow and Company for probably not as long as you did. You've been doing it for longer than I have, but I'm 45 years old. He would start every show with, like you said, free market capitalism, king dollar, Jim, king dollar.
Right. Right.
And cash flows are the mother's milk of the stock market. Now, you have cash flows pre-virus that had slowed to 0% growth in the U.S. He doesn't say jack shit about the dollar at all. He got this part, which is just like, some of these questions too in the queue, and maybe, I don't know if you want to address it just generally, but people are apoplectic watching like these discussions, saying how can the kinds of discussions that you and I are having right now, how can this not be had in America, as in the face of the establishment? Like, do you have any ideas on that? Because I'm certainly game for it if there's a way to do it.
Right. I mean, these discussions, again, I think they really come down to this giant hope that that officialdom, whether it's the Treasury, it's Washington, it's the Federal Reserve, it's the foreign entities that are the equivalent of them all together, can fix this problem. And that's what they're really hoping for, is that they can fix this problem. This problem really being that my portfolio has lost a lot of money. And that's really what's untenable. And I need that to go back up. They don't believe in the Schumpeter creative destruction. For every decline and every change, there's an opportunity. And if you let the organism of free market capitalism exist, it will bend and fold and change itself into something else that's better. We don't want to change anything right now. We want the status quo, and that's what they're really pushing on, is the status quo to hold, right? Print all this money, hold the market up at these levels as well too. If you want to look at a good example is, the auto bailouts of 10 years ago. We couldn't allow, because everybody's got this perception that when a company goes out of business, it goes away. It doesn't go away. It restructures is what it does. It changes in what it is. Yeah. And that we didn't allow the auto companies to restructure and change to the point that we allowed a Tesla to become the bubble that it became, because everybody looked at Tesla and said, they're leading the way to where autos can go. Now, maybe the valuations became insane and ridiculous, but what we also are saying at the same time is Ford, GM, Chrysler, and the rest of you can't. You are incapable of leading us to where we need to go. So we look to these messiahs like the Teslas of the world and say they're going to show us where we need to go with these industries, because we don't allow them to change. Because change means somebody might lose a job, but another job might be created along the way. So we are really trying to recreate January 2020. That's what we really want. We don't want anything to change from that, but it's going to change from that. And that doesn't necessarily, again, that doesn't mean it has to be a disaster. It can just be different, but we don't even want different. We want January 2020. And that's why we're printing all this money and doing all this stuff to try and go right back to there. And, the political establishment, Trump, he wants January 2020 more than anybody else. Remember, he famously tweeted in January 2020, the stock market's up 90% since I got elected. You're not up 90%. What did you do wrong? That's what he wants. He based his whole election strategy on the Dow going higher and higher and higher. And so we'll see. Right now, there's a big hope, especially among the JP Morgans of the world and the Goldman Sachses of the world, that this will work and get them back to where they were in January. But when the reality comes in that they can't get us back to January, then we have to start asking a hard question. Okay, we don't have no economy. We have a different economy. And how's it different? And who are the winners and losers in the new economy? We're not ready to go there just yet.
Yeah, that's a good way to wind up here, man. That's a lot, and it's the truth. And maybe my last question on that is: you go back to January, and I mean, notwithstanding when it was shortly thereafter that Robin Hoodie accounts were driving Tesla to $925. I mean, there's people couldn't see any of this coming. Of course, we had WeWork, we had plenty of imbalances, the biggest corporate credit bubble in U.S. history. But I remember, and I'll never forget. I live in the great state of Connecticut, which certainly isn't a Republican state. I'm not a Republican or a Democrat. I'm a Canadian guy. I just don't like politicians generally. But my most raging Democrat clients, let's just say, institutional money managers, they were kind of okay with Trump. They're okay because it was working, right? They're getting paid, market's going up, they're levered long. They say, he's clever, he's going to keep it going. I don't know how much of that you got in your neck of the woods, but man, they're going to be quick to turn. If what was getting them paid through the lens of they were willing to ignore it. But now they're starting to ask the questions. Was he telling the truth? It's just like the worm's turning pretty quickly here.
Everybody that's listening to this podcast is interested in the investment markets in one way or another. Has there in the history of the world ever been anybody to bitch and complain that they made money? Whether or not it was that they made it by luck, or they made it by smarts, or they fell into it, or they saw it coming. If they bought something and it went up, they're good with it. And don't start telling me that I got lucky or maybe I did, but I'm good with it. I'm good with the president, and I'm good with if this guy keeps tweeting every 3 days that he's causing the stock market to go up, even though I might believe he didn't, it's going up and I'm making money and there's no complaints here. And then the minute it stops going up is when everybody then starts asking the real hard questions.
Yeah, that's the real hard questions. It's getting harder. I mean, he had a tough trade there, President Pump, on that oil trade.
Right.
Hopefully that doesn't happen to the stock market.
It's an amazing thing that what's happening with the oil trade is Trump has, he might not be wrong on it, but he's decided that the energy sector is as important as the consumer sector. Now, from an economic standpoint, that's actually right. If you look at the amount of GDP the energy sector puts out, and the amount of GDP that would be enhanced by an oil price cut, it's about 50-50. And so he's not entirely wrong on that. But boy, he does really come off as trying to say that he doesn't want anybody to have a cut of gasoline prices. They should. If the economy is going to go down this hard, then that should be the natural consequence of it, is $1 gasoline is what it would be. Gasoline is supposed to represent some measure of economic prosperity in the country too, because its demand will move up and down with it. And if we are unemployed, remember the biggest reason you drive is to go to work. And if you are unemployed, then you get the gasoline demand numbers we got today, the lowest ever, because everybody's sitting around talking to people on Skype like we are right now, and we're not in our cars.
Yeah.
And that's going to continue to be the case as we move forward.
Yeah, if you haven't looked at it, which I'm sure you have, maybe others haven't, the Manheim Index, used cars, just complete collapse. And that index, used cars, has been a pretty good leading indicator for a long time, but it's episodic and generally non-trending. But when it crashes for a reason, and it just did again. So that's kind of sad. There's a lot of about this, Jim, that's just sad. And I appreciate that you've been open and honest about it. I think there's an analytical weaponry to that, but there's also a courage. Not everybody, to your point, on Wall Street is willing to. Again, we're not making shit up here. This is the truth, and you've been illuminating, suffice to say, and educational in terms of laying it out there. So thanks for taking the time to do that with me.
Thank you. I appreciate it.
He's Jim Bianco. You can actually find him on Twitter. He's a great contributor to the debate out there, and I think he'll be on the front lines of it. I think you've met three people in particular today that will be. I think courage is a big part of leadership, and it depends on what people want to define America as, but that's how I'm going to define mine. Thanks for joining us today. We will be right back at it tomorrow for the final day of the Investing Summit.